Hello everyone, and once again many thanks for tuning in to our latest investment video. Today I have the pleasure of catching up with Andrew Keeler, who is a director in the emerging markets team at Baillie Gifford, and funnily enough we'll be talking about emerging market equities. But before we start, if you're watching one of our videos for the first time, it would be marvellous if you could subscribe by hitting the button below. Either here or there, I don't know, it's below, you'll see it says subscribe. And if you found the content to be of value, let us know by hitting the like button as well. We have a huge range of financial planning and investment market content delivered each week, so I'm sure there will be something that you will find of value. Anyway, moving on to today's meeting. Thank you very much, Andrew, for your time once again. 2020 was a very positive year for emerging market equities as a whole, but how varied was the performance across the differing economies?
Yeah, I mean, first of all, thanks very much for having me again, Andrew. So I think the short answer to your question is that there has been a lot of variation across different emerging markets. So probably about 60% or so in terms of market performance between the best major performer and the worst, which would be South Korea and Brazil, respectively. So that's obviously not insignificant, but to be honest, I think that variation in performance between emerging markets isn't particularly novel. We'd always expect variance because, the concept of emerging markets is obviously a very broad one. We're dealing with 26 different countries, 26 pretty different sets of circumstances. Average income levels from one to the next can be different by a factor of 10. Some have far better access to resources than others. Some are much better innovators than others. So overall, the dependencies are very different. If we're talking about variation, I think one of the interesting comparisons that continues to be made is emerging markets versus developed markets. And I think it's being made a lot at the moment because during 2020, it's actually been the developed world where we've seen much higher levels of debt accumulation. And in some of the major emerging markets, that's been far less the case. And also in many Asian economies in particular, that they've done a far superior job of responding to the challenges of 2020. I'd also say that just as market performance will vary, so will the types of company that we're able to access across different markets for the portfolio. What we'd like to hope is that we've got a balanced portfolio today with a range of underlying profit drivers, a number of different end markets. So everything from advertising to retail to hardware to copper mining to financial services. There's a wide range of things in the portfolio. I think what pleases us the most about the last year is broadly we've seen very good company level performance across a number of these end markets. I'm not really talking about share prices here because I'm not sure there's a massive link between markets and company level performance in the short run, but I'm talking about the operating performance of the individual companies. And that's where we're taking a lot of confidence, particularly about the way that many of our highest conviction emerging market holdings are setting themselves up for the future as well. If I was to give you just one example of this, I'd probably pick the semiconductors industry. I think it's becoming more difficult to argue against the idea that TSMC in Taiwan is the world's most important chip company.
Absolutely.
It's now operating at a scale and a level of technological competence that no other chip maker can. I remember a couple of years ago, we were talking about the fact that they were spending $10 billion a year on CapEx and how significant a number that was. And now they're talking about $25 to $28 billion of CapEx in 2021, which I think is getting to the point where it's a pretty difficult level to fathom. But when the world's largest chip company nearly triples its capital expenditure in the space of less than 2 years, from already very high levels, then I do think we need to sit up and take note, because the broader ramifications of that does, open up lots of other opportunities. So I've digressed quite a lot from your original question, but I'll stop there.
No problem at all. It seems to me, and tell me if I'm wrong, that it's been more on the Asian side of emerging markets that have performed better. Are we looking for that to continue into 2021, or could we see, Latin America starting to push through?
Yeah, I mean, I think if 2020's taught me anything, Andrew, it's probably that when I'm asked this sort of question, the answer just needs to be that I really don't know. Um, on the shape of the portfolio, I would expect us to continue to retain decent positions in both the structural growth stocks and the cyclical growth stocks. Some of those more cyclical companies are, appearing out with Asia.
Mm-hmm.
Perhaps I'd also just mention at this point what I think one of our biggest risks is in the next year and beyond. Because after a period of strong performance, I think we need to be very aware of complacency as a risk. And I think a big part of what we're going to be doing, regardless of the company in question, is just going to be the nuts and bolts of the investment research process. So revisiting the companies that have done well in particular and checking whether they still meet the hurdle for the portfolio, which as a reminder is that we need to be able to envisage any company doubling over the next 5 years, and we expect most of that to come from earnings growth.
Mm-hmm.
I would say that the research pipeline is very full. There are lots of ideas coming across the desk.
Mm-hmm.
We continue to benefit a lot from our colleagues in Shanghai,
Yeah.
who are living in pretty different conditions from us now. One recent example where their work's been really helpful has been around the Generation Z population in China. So this is a younger cohort of people born between 1996 and 2010.
Mm-hmm.
There's 170 million of those, by the way, and they consume in very different ways from their elders. So we've been looking at live streaming as a revenue source for companies, and that's an area we continue to do a lot of work on.
Mm-hmm.
If I'm thinking about one of the key questions for the next year and again beyond, it's on inflation. What might an environment of reflation mean? How likely is this? On that, I'd say it's quite difficult to grapple with because there are competing forces at play here. On the one hand, you have some very long-term, very powerful deflationary trends which are ongoing across the world. Whether it's the falling cost of renewables, whether it's the ongoing severe price competition from online channels, whether it's the falling cost of tech hardware. That's just a few examples, but I think in each of those cases, there are good arguments to suggest that 2020 has increased the prevalence of these deflationary forces. Mm-hmm. But then at the same time, we've obviously seen more financial stimulus than ever before globally. That's been led by developed markets, and we now have a government in the US where the clear focus is on unemployment. And I think that's going to mean that monetary and fiscal policy remain accommodative. Mm-hmm. We'd also have some sympathy with the idea that industry leaders in many parts of the market have become stronger through the crisis, perhaps at the expense of the less financially stable companies who have suffered. And that might mean that pricing power accrues to fewer great companies. And that's clearly very inflationary. Mm-hmm. Mm-hmm. So I do think we have to be humble enough to admit that we don't know exactly to what extent this idea of a reflationary environment plays out. Mm-hmm. But the reason I bring it up is because we have to think about this very carefully in the context of portfolio risk and our exposures to different countries, as you asked about in the question. Mm-hmm. We want to be able to maintain balance in the portfolio. Mm-hmm. On the one hand, we do continue to have admiration for many of these platform companies whose forces are likely to be deflationary. But equally, in a context of reflation, I think it's important to highlight commodity exposures in the portfolio. Mm-hmm. The shutdown across many parts of the world in the last year has provided an almighty supply shock in commodity markets. Mm-hmm. And that was, after a period where we'd seen pretty low levels of greenfield investment anyway. So, clearly a lot to think about, and that has big implications for the overall shape of the portfolio.
Yeah, and just touching on that, have you made much in the way of change? Are you planning to? Will that come into the internal reviews that you're going to be conducting?
Yeah, that's a good question. I think the honest answer is not that much has changed in the portfolio. And actually behaviorally not making lots of changes when markets are moving sharply isn't necessarily that easy to do. But we're very aware that getting in the way of the power of compounding is a massive risk.
Yeah.
I think that the overall low levels of turnover do reflect the fact that we're happy with the overall shape of the portfolio. It means that recent turnover isn't particularly out of kilter with the long-term average, which is roughly 10 to 20% per annum. If I look at what we have done, to give you some examples, a few areas we've added would be things like e-commerce in Poland. We've been adding to our position in the Brazilian stock exchange, which we think benefits from low interest rates in Brazil. I mentioned live streaming in China earlier. We've been doing some work on Kuaishou, which is the #2 short form video app in China, behind the #1, which is Douyin. That's known as TikTok in the West. Don't know if your next sort of YouTube channel will move on to TikTok, Andrew, but
Who knows?
never. We've also, I think, to fund some of these ideas, we've been moving on from areas where we struggle to see the prospect for that 5-year doubling we're looking for. It's also worth saying as well that one of the outputs of free-flowing money and rising markets has been corporate capital raising. This is something we've done a lot of in 2020. So there was about $3.6 trillion worth of corporate capital raising globally last year, but the average since 2012 has been less than $2.5 trillion per year. So a big uptick. A lot of that has been investment grade corporate debt, but we've also seen IPOs and secondary equity raisings becoming more common. And we've discussed a lot of these as a team. I do think this capital raising goes well beyond just companies trying to maintain liquidity in difficult trading conditions now. We'd hope that some of this spills over into new productive research and development, but I also think we need to be alive to the fact that, in a period of easy money and easy capital raising, unproductive investment may increase. We may see more merger activity, for example. So for us, it always comes back to being very selective and only investing in what we think are genuinely the best long-term opportunities in emerging markets.
Yeah, just finally, and touching on that, do you get involved in IPOs? Is this something that you kind of shy away from, or what's the situation there?
No, we will get involved in IPOs selectively. It really depends on the individual case in question. We do benefit from the fact that at Baillie Gifford, we have a private companies team who spend all their time looking at companies before they come to market. And a lot of the work that they do can be really helpful in informing our views. Yeah. We've also benefited from the fact that some of the companies that have come to market recently have been companies that we've known in the past in other guises. So to give you an example, I mentioned Polish e-commerce before. Yeah. The company we invested in there is a company called Allegro, which is the #1 e-commerce player in Poland. We've actually held that indirectly in the past because it's owned by one of the South African media conglomerates, which sits in the portfolio as well. Or it used to be owned, should I say. They sold that back in 2016. We got to know that company a bit when it was held by Naspers. And so when it came to market in its own right, it wasn't as if we were starting, absolutely from scratch. But it very much does come back to being case by case on IPO.
Yeah, and again, one of the benefits of working with you guys, investing with you guys, is your size, your strength, your experience, the capability that you have in emerging markets, which comes through the performance, the consistent performance. But it's good that you're not resting on your laurels. You're always striving for something better, onwards and upwards. And yes, listen, if people would be interested in seeing perhaps a joint TikTok dance with myself and Andrew, just let us know in the comments below, and I'm sure we can knock something up. Andrew, once again, it's magic to catch up with you. Again, you and the guys have been able to deliver fantastic performance, consistently high performance for all our investors. So thank you for that. I'm sure we'll catch up soon. You take care.
think that final promise there is a sure way to lose subscribers, Andrew. But yeah, thanks very much for having me, and we'll speak again soon.